In this episode of the Seatrade Maritime News Podcast, you'll be hearing from Adam Kent at Maritime Strategies International about the macro outlook for shipping markets in the second half of 2026. Welcome back to the podcast, Adam.
Hi, Marcus, and thank you for having us back yet again.
No, well, thank you so much for taking the time to talk to our listeners. And perhaps you could just set the scene for what has been a somewhat eventful first half of the year.
Yes, of course. We didn't think that the world of shipping could get any more complex. I think 2026 has certainly shown us otherwise up until year to date. The industry has once more been confronted with more geopolitical shocks and a playbook that seems to change almost on a daily basis. But overall, I'd say that certainly from a shipping market's perspective, they've continued to adjust and have performed actually quite well. Of course, a big part of the volatility has been the heightened conflict in the Middle East. And now with the US-Iranian war being a new significant development over 2026, that's certainly shaped the economies and the shipping markets yet further. From a pure macroeconomic perspective, our global GDP outlook has weakened since the start of the war, and we've revised this down from 2.8% to 2.4%, with a lot of that 0.4% drop being a downgrade in expected GDP growth actually in the Middle East. I think at the start of the conflict, there was certainly anticipation that the economy would suffer more than it has. But I think that the oil markets have withstood the loss of volumes via the Strait of Hormuz a lot better than most would have anticipated at the end of February. Industrial production remains similar to pre-war levels. And while we've seen some increase in headline inflation by about 1% in the US and Eurozone compared with February, it certainly hasn't exploded like it did 2 or 3 years ago. I think two of the broader drivers that are helping to support the economic resilience continue to be the strength from Chinese exports. And there are a few signs that we've seen that the Iranian war have dented global demand for Chinese goods. And of course, we continue to see the sort of heightened investment tied to AI and all things AI. And that AI investment boom is certainly giving a significant lift to the US, Chinese, Korean, Taiwan economies. Generally in the US, our 2026 GDP growth forecast now sits at around 2.1%. That's a slight downgrade to where we had it at the start of the year by about 0.2%. And that downgrade basically just reflects our view of the gradual drag from the higher energy prices, weaker real income growth, and slower consumer spending. Though the US still remains relatively insulated compared to other advanced economies. Overall, however, we think that the sort of risks do remain on the downside, especially in Europe and East Asia. The picture here is that economies are still expanding, but they've become a lot more fragile. And with the higher energy costs, the disrupted trade routes, and those commodity prices are certainly putting pressures unevenly across these different regions. Our core view certainly remains that the longer term, the longer we see the disruption to oil and gas supplies, the greater the negative impact this will be on the global growth. However, we have sort of become a little bit more optimistic about the world's economy resilience to withstand these geopolitical headwinds, given events that we've seen over the course of the last 5 years and just how well the global economy has performed. If we look at from a more of a shipping perspective, certainly on the earnings side, sectors have continued to perform well, and in some cases exceptionally well in 2026. And this is perhaps somewhat surprising at a headline level if we just look at where we expect global seaborne cargo growth to be this year. We actually expect to see cargo growth at around -1% in 2026. And that's largely due to the lack of volumes going through the Strait of Hormuz given the war in the Middle East. Therefore, the support in the market continues to come from the inefficiencies that we see across the various sectors of shipping. longer ton miles, slower speeds, longer waiting times to get into ports and general disruption. And we've also pushed back our expected timings to see returns to transits via the Red Sea into 2027. Again, that continues to support market balances. And at the same time, we've recently seen the Panama Canal Authority reduce the number of transits it's expecting through the Panama Canal due to drought conditions. And with this year being a potential severe El Nino year, we could see further reductions in Panama Canal transits, which again would help support market balances for most shipping sectors. On the supply side, ordering continues at a pace. So we're seeing similar volumes being ordered over the course of the last 5 years as we did during the super boom years between 2003 and 2008. Containers ordering has, passed the mantle over to the oil tankers this year, and oil tankers have certainly taken the lion's share of all orders, while scrapping generally remains at a snail's pace. We've seen virtually no scrapping over the course of this year, counter to the high ordering volumes that we have seen. So I think this time last year, when we did a similar podcast, I did comment on that it's been a very eventful start to 2025, and I think we can say something very similar. And it seems to be a playbook that seems to be playing out pretty much over the course of each of these podcasts that we do, that there are always a series of events, as you sort of said in your introduction, Marcus, that have been shaping the shipping markets and continue to shape the shipping markets as we move forward over the course of 2026 and into 2027.
That's all we have time for today on the Seatrade Maritime News Podcast. Thank you for listening, and we look forward to joining you on the next episode.